Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, let's start with the big picture here, the core structural shift. Because Applied Digital is really moving from, what felt like a speculative construction company.
Pure build-out story, yeah.
Exactly. And now it's becoming an operational, revenue-generating HPC provider, and it's focused almost entirely on AI workloads, which is, that's where all the demand is.
And what's really, I think, amazing here is how fast they've de-risked that whole transition.
Yeah.
We're looking at a $16 billion contracted backlog.
$16 billion. That number is just, it's hard to get your head around.
It is. Yeah. And it gives them revenue visibility for 15 years. This isn't your typical tech speculation. It's structurally de-risked because they have these 15-year lease agreements signed with investment-grade hyperscalers.
And when we say hyperscalers, we're not talking about small players. This is Microsoft, Amazon, Meta.
The giants. The ones actually spending the hundreds of billions of dollars on the AI build-out.
Right. So the quality of the customer is just top tier.
Absolutely. And these aren't just simple contracts. A lot of them are take or pay. So those companies are locked in. They're leasing critical infrastructure for over a decade. It basically turns Applied Digital into a specialized AI landlord.
So more like a utility with hyper growth.
That's a great way to put it. It moves them out of that volatile cloud category and into something, much more predictable and stable.
Okay, but 15 years of visibility is one thing. They still have to build this stuff. How do we know their execution is actually, keeping up? What's the proof that they're turning concrete into cash flow?
We have it. The Q2 fiscal 2026 results. They really validated the whole thesis. Revenue hit $126.6 million.
Wow. And what does that look like year over year?
It's a 250% increase. And maybe more importantly, it crushed consensus estimates by something like 46%. So that tells you the ramp-up isn't just happening. It's happening ahead of schedule.
That kind of ramp-up must be incredibly expensive, though. What does the path to actual profitability look like right now?
Well, the leverage in the model is really starting to kick in. Of course, they have huge depreciation costs, financing costs. That's normal for a big build-out.
Yeah.
But the operating economics are already strong.
Okay.
Their adjusted EBITDA, which is key, was already positive in Q2. $20.2 million. So the assets are already generating positive cash.
And management feels good about that trend continuing.
They're extremely bullish. They believe they're going to exceed $1 billion in annual net operating income, or NOI, within just 5 years.
$1 billion in NOI.
Yeah.
That's the kind of number that forces a complete re-rating for an infrastructure company.
It is. And the growth is just accelerating from here. Fiscal 2027 estimates are pointing to between 86 and 93% growth as their main campuses come fully online.
Yeah.
And that's the year analysts expect them to hit positive EPS.
Which is the magic moment when a lot of the big institutional money really starts to pay attention.
Exactly.
So let's shift to their advantages. In the world of AI infrastructure, it feels like everything comes down to two things: power and cooling.
That's it. And Applied Digital seems to have built a serious moat on the power side of that equation.
What does that look like?
They managed to secure exclusive access to really, really low-cost power, especially in their Dakota campuses. And this is a huge strategic advantage because those areas have tons of energy and, critically, a grid that can actually handle the massive power draw these centers need.
Which is a problem everywhere else. Everyone's fighting for grid access.
Right. Power can be 60% or more of a data center's operating cost over its life. So if you win on power, you're basically winning the whole economic battle. It's very hard for a competitor to just show up and replicate that.
And what about the other side of that? The cooling. These new GPUs run incredibly hot.
They do, and that's maybe their biggest technology edge. They use a proprietary liquid cooling technology that's just way more efficient for these dense AI workloads.
How much more efficient?
The company claims it's up to 3,000 times more efficient than traditional air cooling. And they're not standing still. They invested $15 million into a company called Corentis to keep developing even more advanced solutions.
So they're not just buying fans, they're engineering the whole thermal system.
Exactly. It means they can handle the most powerful, most densely packed GPU clusters that are coming down the line.
So how do they defend this position against, say, the huge legacy data center REITs, or even the hyperscalers building their own?
It really comes down to high switching costs. When you have a cornerstone lease, like their $5 billion 15-year deal, you lock in that market share. These facilities are often custom built for the client.
Ah, so once a tenant puts billions of their own servers and GPUs into those specialized racks.
They're not moving.
Yeah.
The cost and disruption would be prohibitive.
Hmm.
So Applied Digital is in this perfect sweet spot. They're faster and more agile than a traditional REIT, but they have more real assets and revenue certainty than the smaller neocloud guys.
And this whole aggressive build-out isn't being held back by a lack of cash, which is what usually kills these kinds of growth stories.
No, and that's a crucial point. It's structurally supported.
Hmm.
You have Macquarie-backed financing and really telling capital commitments from NVIDIA.
NVIDIA's involvement is a huge vote of confidence.
It's more than just money. It's a validation of their tech and their importance in the AI supply chain. Having those two big names involved just takes capital constraints off the table for the near term.
Okay, we've got the foundation, we've got the moats, but what are the near-term events? What's going to actually make the market see this company differently?
The biggest one, by far, is a corporate action. It's the spin-off of a business called Chronoscale.
Right. They're separating their cloud computing business and merging it with another company, Exobionics, to create Chronoscale Corporation.
Correct.
So walk us through why this is so important. It sounds complicated, but the goal is actually simplification, right?
That's it, exactly. It's all about getting rid of what's called a conglomerate discount. The market has had a tough time valuing Applied Digital because it was two different businesses in one.
You had the stable infrastructure landlord, and then you had this smaller but potentially higher margin cloud GPU services business. And the market just assigns totally different valuation multiples to those two models.
The cloud services part should trade more like a software company. It should. So by spinning off Chronoscale, the parent company Applied Digital becomes a pure-play AI infrastructure landlord. Super clear, REIT-like economics. And Chronoscale can then be valued on its own as a specialized cloud provider, which should get that much higher multiple. It's a classic move to unlock value that's just, trapped inside the corporate structure.
And while all this financial engineering is happening, they're still expanding the physical footprint.
Oh yeah, the pipeline is not slowing down at all. Management is already in advanced talks for 3 more sites. And we're talking about a massive 900 megawatts of additional capacity.
900, so that $16 billion backlog isn't the end of the story.
Not even close. It's the foundation. That new capacity underpins their upgraded NOI goal and just shows the growth engine is still running at full speed.
Let's talk valuation, because the stock had a monster run in 2025, up something like 237%. But it still seems like the market hasn't fully priced in this operational shift.
There's a pretty big disconnect there. The company's market cap is hovering around $6.7 billion.
Okay.
But you're comparing that to a $16 billion contracted revenue backlog. You have more than double the company's entire value already secured in long-term contracts. It suggests the market is still pricing in a lot of execution risk that might not be there anymore.
And the analysts seem to agree there's more room to run.
They do. Price targets are generally between $39 and $56, which is, 49 to 97% upside from where it's been trading recently.
Yeah.
And you've also got this interesting technical setup with high short interest.
Ah, so any more good news could potentially squeeze the shorts.
It could, yeah. If they keep executing and the Chronoscale deal goes smoothly, there's potential for a sharp move up.
All right, to keep this balanced, we have to look at the other side. What could actually derail this whole story?
The primary risk is, and always will be, execution. The build-out is just enormous. It needs flawless project management. Any delays in construction, or even worse, any problems getting the power grids connected on time, that could push the revenue out.
And grid interconnection can be a nightmare of red tape.
It can. We've seen other companies get really bogged down by it, so that is a fundamental vulnerability. The whole thing depends on flipping the switch.
So what's the mitigation for that risk? How are they protecting against it?
Well, this is what makes it so compelling. First, the financing from Macquarie and NVIDIA is already secured, so funding isn't the issue. But more importantly, those 15-year leases are take or pay.
Meaning the revenue is guaranteed even if there's a small delay.
Exactly. The cash flow is certain, the customer's on the hook, the timing might shift by a quarter, but the money is still coming in. It's a huge buffer.
Okay, what about a secondary risk? I'm thinking about concentration and just the valuation itself.
That's a fair point. They are heavily tied to just a few big hyperscaler tenants right now, especially that huge $5 billion lease. That's a customer concentration risk.
And the valuation multiple is pretty high for an infrastructure play, right? Around 30 times sales.
It is, which normally would be a red flag. It's a huge multiple. But the counter-argument is all about the context of the AI market itself. The AI spending cycle is over $400 billion a year, and it's still accelerating.
So the demand is there to diversify their customer base as new sites come online?
That's the idea. And as for the valuation, that $16 billion in backlog provides a really strong floor. And again, the Chronoscale spinoff is specifically designed to fix that valuation puzzle. It separates the two businesses so they can each be valued properly.
Okay, so wrapping this all up, what's the final takeaway?
So what this all means for you is Applied Digital is really a high-conviction way to play this AI infrastructure supercycle. It's moving from being a speculative builder to a mission-critical landlord with just a massive, stable revenue pipeline already locked in.
And how should people think about the timeline for an investment like this?
We'd frame it as a multi-year hold, say 12 to 36 months, as they scale up toward that $1 billion NOI target. But, there's definitely near-term tactile upside around things like the Chronoscale deal finally closing or another big lease being announced.
I think that the biggest idea here, the thing to really think about, is that this spin-off, the separation of the two businesses, it's going to force the market to reevaluate what this company actually is. It removes the confusion. It asks you to consider, are you valuing a stable utility with growth, or are you valuing a high multiple cloud provider? And the answer is about to become both. If you want to keep up with the latest updates on this dynamic stock and others like it, make sure you subscribe, like, and comment underneath to support this show.